From Signal episode 15 through to episode 24, we've covered India's major sectors, starting from banking and financial services through consumer and retail, IT, autos, capital goods and manufacturing, energy, power and renewables, metals and materials, pharmaceuticals and healthcare, and finally, real estate. Together, these sectors represent the core drivers of growth, earnings, and long-term wealth creation in the Indian economy. Today, in Signal episode 25, let's wrap up sectoral journey by focusing on supporting sectors: chemicals, telecom, logistics, textiles, and non-power utilities. These sectors enable growth, improve efficiency, and strengthen economic system alongside core sectors already covered. So let's begin with strategy of the week, then move to story of the week, reflect on quote of the week, and conclude with market highlights. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. As investors mature, understanding markets is not just about identifying growth engines, but it's also about recognizing what enables those engines to perform efficiently. Chemicals support manufacturing depth across industries where pricing power and margin discipline matter. Telecom supports digital infrastructure and connectivity where long-term performance is influenced by prudent capital allocation and regulatory stability. Logistics determines how efficiently goods move across the economy, with long-term performance closely aligned with economic throughput and industrial activity. Textiles connects India to global demand cycles influenced by exports and currency dynamics. Non-power utilities like gas distribution, urban infrastructure services, and water utilities support urbanization through regulated and contracted framework, where long-term performance depends on disciplined execution. So, the practical question is, how can investors participate in these sectors? Most investors can access these sectors through diversified equity funds, including multi-cap, flexi-cap, and infrastructure funds. Others may choose to invest directly in shares, provided they understand sector cycles, regulatory framework, and cost structures. Because ultimately, investing isn't just about choosing the right sectors. It's about building and gaining clarity on how those choices fit in your larger financial life. Selecting the right mix of investment vehicle requires structure. A SEBI-registered investment advisor can help align sector exposure with your risk appetite, long-term goals, and overall portfolio strategy. And that brings us to our story of the week. Meet Dr. Asha, one of our long-standing client who rarely chases the headlines. For her, investing is intentionally structured and calm, designed to grow steadily in background without demanding daily attention. She allows her SEBI-registered investment advisor to structure and manage her investments so that she can focus on doing what she is best at, looking after her patients, supporting their mental well-being, and spending time with her two beautiful children. She only reviews her portfolio during scheduled reviews: how much to add, how much to draw, and if rebalancing is required. There is no need for daily monitoring because the structure is already well designed. Her portfolio holds diversified funds that provide exposure to logistics, telecom, utilities, and industrial inputs, sectors that support economic growth. In her own words, "I'm clear about what I do best. I have studied psychiatry. I'm proud of my work and I focus on caring for my patients and my family. I allow my SEBI registered investment advisor to do what he is best at, structuring, and managing my investments. There is clarity, there is balance, and that balance is invaluable. And this idea of balance and partnership isn't just unique to her. In fact, Warren Buffett once said about Charlie Munger that Charlie pushed me in the direction of not just buying cheap stocks, but also buying wonderful businesses. As we all know that Warren Buffett is one of the world's most successful investors, but yet, despite that success, he allowed Charlie to refine and shift his thinking. And that's the lesson I would like to leave you with. High achievers don't try to master everything themselves. They build structured partnerships, they delegate with clarity, and they respect expertise. If you are exceptional at what you do, partnering yourself with an equally capable professional elevates your outcome. Clarity of roles doesn't reduce potential, it expands it. In the past 3 weeks, market gains were driven by selected stocks and sectors rather than gains across the board. Companies with strong margin control and balance sheet discipline like State Bank of India were rewarded, while earnings disappointment like Muthoot Finance and Hindalco saw sharp reactions. After a strong start to 2026, markets experienced tactical profit booking. For instance, Nifty Metal corrected by 10%. The sharpest pressure in February came from IT sector, influenced by global tech sentiment and expectations of US rate cuts. Foreign flows remained sensitive to global bond yields and dollar strength, contributing to market swings. And this was despite relatively stable domestic fundamentals. With rupee continuing to weaken, non-resident investors may find opportunity in deploying stronger dollar capital into quality Indian assets, benefiting from both valuation resets and currency dynamics. As we conclude our sectoral journey, from next episode, we'll shift our focus in decoding investment intelligence. We are building a strong community of curious, confident, and committed long-term investors. If you're one of them, why not like and subscribe us and tell us in comments. When you hear a financial term, do you understand it or you simply recognize it? Let's change this together.